Hello, you're joining us for an episode of Lowcountry Money Talk, and of course, we're going to kick it off with some current events. I have good news for you because, as usual, we have an expert to talk about these current events, and there's a lot to talk about. Phil Bloyd is here with Revolutionary Financial Group, going to march us through some of the things that are happening. Nice to see you.
Good to be here, Jessa.
It's a lot that's going on. We've been talking current events, wondering if the picture is getting any better for folks, but not so much. Let's talk about what's happening.
Seems like we're stuck in the mud still here.
Yeah.
So the latest came out, the gross domestic product, the companies, or the countries, we'll say, income, a negative 1.4%. And the experts were basically predicting the exact opposite of about a positive 1.4%. So that's a pretty big switch.
It's a big switch. One thing that has been consistent, it seems, in our conversations, Phil, is that typically the experts are getting it wrong right now.
Yeah, it seems like.
It does.
It was funny that, I was watching a morning show, and before the numbers came out, they had the I'm not going to mention the bank, but it was a CEO of a major bank in the U.S., or in America, we'll say, and he had the opposite thoughts on things, and then just 2 hours later, and he, the problem with that is when you're in that position, you have the top advisors in the world working for you,
right,
and access to all of that data,
right,
and you got it wrong.
And you still got it wrong, right.
So that's kind of scary a bit, I think. Now, they did say a lot of that has to do with trade deficits and this and that, I don't know. We've got the problem in Shanghai, China, where they locked down the whole city. I forget how many, over 10, maybe 25 million people.
That's incredible, and wow, what an impact that has made, of course.
Well, yeah, and I have a friend that I served in the Marine Corps with, and he is a longshoreman in Long Beach, California, which is one of the largest, I believe, port. And I spoke to him this week, and I'm like, well, man, you better get your tail down there and get those ships unloaded. And he said, we only have 3 ships anchored here. And he sent me the map, and he said, we don't have a backup here at all.
Wow.
And then if you see the map of Shanghai Harbor, all of these ships are sitting there like they were off the coast of California last year.
Just the same problem. I know they're reliving sort of the pandemic lockdown, and of course that is having a ripple effect on our economy and everything that goes along with that. We lived it, so we know what that looks like already. But, talking about this, and, maybe this just speaks to the uncertainty and the volatility that we're experiencing when you talk about these experts getting it wrong so many times. Is that a sign of just volatility and uncertainty, or is it a sign of we're just missing the mark? What do you think?
I just think there's so much uncertainty now because you don't really know how shutting down a city like Shanghai that has all this output for a month or so, it's going to affect, but you don't really know how bad.
To what scale?
So there's a lot of guessing and assuming, I would say. But, we have energy prices continuing up, and the government's tried to do several things, releasing the reserves, all these different things. They may bring it down for a minute, then it goes right back to the way it was.
Yes.
So there's just a lot of stuff going on.
There's a lot of stuff going on, and of course, we're dealing still with inflation. We're talking about potentially food shortages. We'll talk about that as well. We've got more current events to discuss, but with this negative GDP number, you were mentioning that we're now in a place where one more quarter is officially a recession. Is that accurate?
Right. So if we have 2 back-to-back negative GDP quarters, then it's an official recession. And some people are saying, the Fed, who will meet next week, I don't know when this is going to air, but the first week in May, they're expected to raise interest rates another 50 basis points, or 0.5%. And some people say, hey, they're doing that they're going to sacrifice a little bit of a recession or so to help offset inflation.
Wow. Okay. Well, lots to talk about. I think we could probably unpack that a little bit more after the break and talk a little bit about what this all means for you all who are watching at home, which is what we'll get to shortly after this break. Stick with us. Welcome back in. You're watching Lowcountry Money Talk. If you are just tuning in, we spent about 5 minutes or so talking current events, which, you know, is a little bit hard to get into 5 minutes, quite frankly, because there's so much going on. However, we're talking about it in relationship to money, what that means for you. And of course, Phil Bloyd is here to help us navigate this. And Phil is with Revolutionary Financial Group. So, important things to talk about now. As you mentioned before the break, you were talking a little bit about the Federal Reserve set to raise interest rates, and you were saying we're looking at 50 basis points. So what we need to know from you, Phil, is how does this, in your expert opinion, look to affect the market?
Well, I think, Jessa, that the stock market has already implemented or absorbbed that 50 basis points. So as long as we're there, business as usual, I would think, which is volatility.
Which is, yeah, business as usual is a roller coaster.
If they would go higher than that, that would be a surprise, and Wall Street doesn't really like surprises. If they would go lower than that, then that would probably be a good surprise, but I don't see much of a chance of that. So I would think that that 50 basis points would kind of go in there, and then we would just continue on track because the market is forward looking. It's already seen into that. Right before the break, there was one thing, I'll just back up a little bit. We talked about Goya, the CEO of Goya.
I'm glad you brought that up because food shortages.
Yeah, he was not guessing on that at all. He said there's going to be a food crisis. And I mean, here's a guy, it's his job to know.
Right.
And they're out, you know, buying foods from all these places and processing them and canning them and getting them out to the market. So I would think that he would know this.
Well, when you hear people talking about that, and you know, obviously inflation and things play a role to what we're seeing in grocery stores. When you hear people talking about that, it causes concern for obvious reasons. You hear maybe politicians saying something, or you know, experts. But this is an expert in this specific industry who is saying it's not if, it's when.
He was pretty adamant about it's going to happen. And he was saying this year. And then we take into account, like you had mentioned to me earlier, about the fertilizer.
Yeah, I've been reading about that. So think about that in terms of just domino effect. Can't fertilize your crops, or you know,
it costs
prices.
You 4 times as much.
Absolutely.
Because of Russia and Ukraine being a major producer of fertilizer. So anything that comes out of that area is going to have some disruption. And if you think about the farmers are already planting, or they already planted, in many cases they've already used that fertilizer.
Right.
So they're going to pass that cost on.
Yes.
And if you haven't been to the supermarket lately, I mean, we're buying foods that were processed before that. So once the cost of that increased, or the increased cost of that fertilizer goes in, you know, you can just imagine the cost of that food then.
Yeah, absolutely.
Yeah.
Well, you know, and this is all causing issues and concerns for those who are in retirement now or entering retirement, because obviously we're working on, you know, a timeline here and potentially limited resources. So you're watching your stocks and everything fluctuate. We only have a minute left in this segment, so we might have to kick this to the next one a little bit. But what we want to do is translate this concern to a plan, and how do we actually plan then for the volatility?
Sure. Well, I think, Jessica, first of all, there's probably some people out there watching, they're like, well, this is about money. Why are you talking about fertilizer?
Yeah.
Horse manure.
Right.
It's more than that, but let's say. Well, because that is affecting the returns on your assets. So if we don't speak about this, you're like, why is all this happening?
Exactly.
You know, you look at the increase in energy costs. Whoa. And usually when energy increases, it can lead into a recession because we use energy for everything. Every apple you buy has to be transported. And, you know, those trucks aren't driving on pixie dust.
Right.
So all of that's going to affect the market. If you have money in the market, or nowadays, even if you're receiving interest, which interest rates are moving up, all these things are interconnected, and our viewers need to know.
Yes, absolutely. So we'll spend more time talking about what you can do about it as we get to the other side of this break and give you some pointers. Well, I won't. Phil will, because he's the expert. We'll be right back. This is Lowcountry Money Talk, and if market volatility has you losing sleep, well, we've got you covered, at least in terms of expert advice, because Phil Bloyd is returning with us here, and he's with Revolutionary Financial Group, talking everything money, current events. We're talking food shortages. We're talking inflation. We've talked about the negative GDP. Boy, we've talked about a lot already.
That's heavy lifting. Luckily, I'm a former power lifter, so we just lift it right out.
That comes in handy on the show sometimes, you know.
Right.
But, you know, we want to now really bring this home for our viewers so that we can start learning what to do about it. And for those of our viewers who are in retirement or soon to enter, it's a conversation that we need to have now about how do we handle this? How do we plan for this? What do we look at when we're dealing with all these variables?
Sure. Well, the first thing I think we need, you know, growing up in a Midwest or Southern state is a good measuring stick.
Okay.
So our measuring stick right now would be the S&P 500, which a lot of people use as a benchmark to analyze the return on their investable assets. So as we are speaking here today, that index is down about 12% for the year. Okay, so we can take that. The other thing we may consider, a lot of people may like tech stock and this and that. So the NASDAQ index is down 20%. So that's a bear. If we're down 20%, that's a bear market. So the NASDAQ is actually in a bear market.
Right.
So where does your assets fall on our measuring stick?
Right.
So if we're at a negative 12 benchmark,
Okay.
and your growth portfolio is at a negative 8, you're ahead of the benchmark.
I suppose that's a positive thing.
You would think, but you know, some people get heartburn over that.
Yeah.
So, you know where you're at on the measuring stick.
Okay.
And you know, you may be uptight. Some people don't get uptight at all. They're like, oh, it'll work itself out. I mean, just remember you're retired now.
Yeah, there's a scale of maybe how easy you should be about it too. Don't lose any sleep over it, but you don't want to let it slide and get yourself into trouble and be losing money.
Right.
That, you know, leaving it on the table too.
Sure.
So, okay, so what do we actually do? What's the steps that we take to take a look at these things, and if we want to, you know, call your office and and actually, you know, really analyze our portfolio?
The first thing we need to do is do a portfolio analysis, because a lot of people don't know where they fall on that measuring stick.
Right.
So once we do a portfolio analysis, it will tell you, hey, you know, these indices are at this percent and you're here. You know, and then it'll also unwrap. So a lot of people may have mutual funds or exchange traded funds or things of this nature. So they may not know what stocks are really driving them down.
Sure.
So this portfolio analysis, Rachel would be the one to contact to get on board with that. And when you call, you know, usually it works for people that have about 500,000 or more investable assets, because we're going to want to input enough in here where we can really get a good measurement on things.
Absolutely.
So once we do that, if you have a lot of mutual funds or ETFs, it's going to otherwise unwrap those and tell us what stocks we have within those funds. And then we can look back and say, okay, well, here's the
Here's your
problems
problem.
here. Yeah.
Here's what's doing well. Let's keep that. Here's what's dragging you down. Well, and it's interesting how few people really take the time to have that full understanding and how much money that could be costing them by not knowing.
The other thing is fees and expenses.
Yeah.
So that will also be exposed in that portfolio analysis. So, you know, we may be down in those, if we're paying an excessive fee, whether it's internal or external, that can pull us down even more.
Right.
So it's important to know. And, you know, when everything's lovely and the sun shines out and the market's way up, people tend to be, you know, I'm not too worried about it. But when things hit the bricks, you know, then they're like, oh, I better check this out, or what do I do, or deer in the headlights, right?
Absolutely.
So that portfolio analysis will help.
You need to know that. The other piece of the puzzle, of course, is risk. And we'll talk a little bit about that after the break. Phil's got some basic tips for us. We have to head to break, but just as a teaser, give us tip number 1 that we'll talk about.
Don't overexpose yourself. You may get sunburn.
We don't know what that means, but that's okay. We've got a whole nother segment to tell you what that means and more tips for you. That's coming up next. This is Lowcountry Money Talk, and we're on the back side of this break. In fact, we're on our last segment of this episode. Where we left you before the break was don't overexpose yourself.
Yeah.
I'd say that's good advice for anybody.
Market rash.
Market rash. Phil Bloyd's here with Revolutionary Financial Group, walking us through some pointers on, you know, what all of this means for us, the market volatility, the, you know, inflation, the negative GDP, but most importantly, what can you do about it? And some tips and pointers are what we're looking for. So first one, don't overexpose yourself. How does that relate to money?
Well, you know, if I'm 80 or 75 and, you know, I'm having some restless nights, the best thing we can do is make sure that we don't have too much exposure to the market. Yes. So we don't want to be overly invested, you know, that's probably the biggest thing. So some people I've met, Jessa, they're like, I don't want anything in the market. Like, we could call that underexposure.
Okay.
We get hypothermia on that one. I don't know. But then
you want the right amount of exposure.
Right.
Okay.
The right amount, the right mixture. So, you know, if that stock market is only 30% of my overall asset class, or the risky part of the stock market, we'll say, if it drops, you know, 50%, that's 15%. Bad enough, but still a smaller part of the overall picture.
Right.
So, you know, some people are like, well, the S&P index is down 12 and I'm down 4. That's horrible. Well, if you feel that way, then probably you're suffering from overexposure.
Overexposure, wow. Okay.
And we got to get some allo analysis for you, you know, right away to help you out.
Yes, okay,
So
I like that one.
Thing, right?
That's really good.
So.
All right, and now let's talk about some others as we roll through here.
Sure. Act your age.
Act your age.
Yeah.
Okay.
Many people sit down across from me and they'll come in and I'm like, my gosh, you look a little aged for a 30-year-old. And they're like, what are you talking about? I'm like, you have the investment portfolio of a 30-year-old. So again, if I'm 75, I probably don't want 75% of my portfolio exposed to very risky assets.
This is a very interesting topic, actually, because, you know, you've heard about these things that can tell you what your real age is and things like that versus, you know, how long you've actually been on the planet. This is an important one too, though. Yeah. How old is your portfolio versus how old you are?
Right.
So you've got to have the right mix, the right portfolio for where you are in life.
Yeah, sure. And the problem with that is with this bull run that we've had over the last 13 years or so, many people have just, you know, they haven't taken the gains and pulled back to a more moderate or safe side of things, and they've let that continue up, and they just, everything's lovely. Well, they missed out a big part of the, you know, the investment side of things that says, hey, make sure you don't expose too much. So if we had this huge bull run over the last 13 years, but we lose it all back, but now we're retired, we've got big problems, you know.
Problems.
And I'm overaged anyway, because they say if you're in the Marine Corps, for every year you serve, it's like 3 years.
Wow.
So I did 9. So I'm at least, what, 100, how old did you say the fellow was you met?
I interviewed a 100-year-old recently. Oh, 118. Let's talk. Speaking of age, is the oldest living person right now. So their portfolio needs to be.
Takes a lot of money to live to 118. I'm guessing.
It does. Okay, we have a few more to get to.
Sure.
I want to talk taxes. That's a big one.
Sure. Watch your taxes. So again, we want to protect our income. So let's go back a bit and say, if the market's down, we don't want to have to sell an asset that's in a decline to take income. So it's very important that we have another asset class that isn't in decline that we can take income from. So that would be important. The other thing we want to look at is if we can save money in taxes, if we can save money in expenses, then that's less income that we'll need out of our portfolio. So we need to clean this up just a little bit. And the good news is, Jessa, once we clean it up now and we get back into the next bull market, you'll be even better prepared for the future.
Right. Well, hey, that's good to know. That's just 3 pointers of a long list that you have. Sure. But that's a good place to leave it. You'll have to stick around for our next episode to talk more about what's happening. Phil, thanks so much.
All right. Glad to be here.
Sure appreciate it. We appreciate you. We'll see you next time on Lowcountry Money Talk.